Articulation Practice, Day 4. Today I'm going to read the article from The Verge. The title is The Tech Industry Moved Fast and Broke Its Most Prestigious Bank. The story of the fall of Silicon Valley Bank explained. The fall of Silicon Valley Bank. Silicon Valley Bank explained. Written by Elizabeth Lopato on March 12, 2023. Alright. On the last night of its on the last night of its existence, Silicon Valley Bank was hosting VC Bill Reichert of Pegasus Tech Ventures, who was giving a presentation on how to pitch your wow to investors to about 45 or 50 people. Mike McEvoy, the CEO of OmniLayers, recounted the scene for me. It was eerie over there, he said. He saw a number of people exiting the building during the event, looking subdued. Roger Sanford, the CEO of Healthcare Health and self-described professional Silicon Valley godfly, was also there. Everyone was in denial, he told me. The band played on. The next day, the emblematic bank of the tech industry was shut down by regulators, the second biggest bank failure in US history, after Washington Mutual in 2008. What happened is a little complicated, and I'll explain further down, but it's also simple. A bank run occurs when depositors try to pull out all their money at once, like in It's a Wonderful Life. And as It's a Wonderful Life explains, sometimes the actual cash isn't immediately there, because the bank used it for other things. That was the immediate cause of death for the most systematically and symbolically important bank in the tech industry. But to get to that point, a lot of other things had to happen first. So what is Silicon Valley Bank? Founded in 1983 after a poker game, Silicon Valley Bank was an important engine for the tech industry's success and the 16th largest bank in the US before its collapse. It's easy to forget. Based on the tech industry lionization of nerds. But the actual fuel for startups is money, not brands. But the actual fuel for startups is money, not brands. Silicon Valley Bank provided that fuel, working closely with many VC-backed startups. It claimed to be the financial partner of the innovation economy and the go-to bank for investors. Among those banking at SVB, the parent company of this here website. What is that supposed to mean? The parent company of this here website. That's not all. More than 2,500 VC firms back there, and so did a lot of tech executives. It fell in less than 48 hours. What happens to Silicon Valley Bank's customers? What happens to Silicon Valley Bank's customers? Most banks are insured by the Federal Deposit Insurance Corporation, or FDIC, a government agency that's been around since the Great Depression. So, of course, the account at Silicon Valley Bank were insured by the FDIC, but only up to 250,000 US dollars. That's how FDIC deposit insurance works. That might be a lot of money for an individual, but we're talking about companies here. Many have burn rates. Many have burn rates of millions of dollars a month. A recent regulatory filing reveals that about 90% of deposits were uninsured as of December 2022. The FDIC says it's undetermined how many deposits were uninsured when the bank closed. How bad could it get? 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 Damn. Even small disruption to cash flow can have drastic effects on individuals, companies, and industries. So, while one very likely outcome is that the uninsured depositors will eventually be made whole. The problem is that right now they have no access to that money. The most immediate effect is on payroll. There are lots of people who are wondering if their next paycheck will be disrupted. Some people already know their paychecks will be. A payroll service company called Rippling had to tell its customers that some paychecks weren't coming on time because of the SVB collapse. For some workers, that's rent or mortgage payment and money for groceries, gas, or childcare that isn't coming. This is especially rough for startups. A third of Y Combinator companies won't be able to make payroll in the next 30 days. According to YC CEO Gary Tan, an unexpected mass furlough or layoffs is a nightmare for most companies. After all, you can't make sales if the sales force isn't coming into the office. You can't make sales if the sales force isn't coming into the office. Some investors are loaning their company's money to make payroll. Penske Media, the largest investor of this website's parent company, Fox Media, told the New York Times that it was ready if the company required additional capital. It was ready if the company required additional capital, for instance. That's good because Fox Media has a substantial concentration of cash at Silicon Valley Bank. Of course, one other problem is that a lot of investors were also banking at SVB too. Payroll isn't the only expense a company has. There are payments to software providers, cloud services, and so on too. I'm just scratching the surface here. Does this have something to do with crypto? As Phoebe's failure didn't have anything directly to do with the ongoing crypto meltdown, but it could get potentially worsen that crisis too. Crypto firm Circle operates a stablecoin, USDC, that's backed with cash reserves, 3.3 billion of which are stuck at Silicon Valley Bank. That stablecoin should always be worth $1, but it broke its peg after SVB failed, dropping as low as 87 cents. Coinbase stopped conversions between USDC and the dollar. On March 11, Circle said that it will stand behind USDC and cover any shortfall using corporate resources involving external capital if necessary. The stablecoin's value mostly recovered. Oh, and bankrupt crypto lender BlockFi also has 227 million US dollar in funds stuck too. So if SVB doesn't exist anymore, what takes its place? In response to the collapse, the FDIC created a new entity, the Deposit Insurance National Bank of Santa Clara, for all insured deposits for Silicon Valley Bank. It will open for business on March 13. People who have uninsured deposits will be paid an advance dividend and get a little certificate. But that isn't a guarantee people will get all their money back. The FDIC's job is to get the maximum amount from Silicon Valley Bank assets. That can happen in a couple ways. One is that another bank acquire SVB getting the deposits in the process. In the best case scenario, that acquisition means that everyone gets all their money back. Hooray! And that's the best case scenarios. Not just for everyone who wants to get the paycheck on time, but also because the FDIC's greater mission is to ensure stability and public confidence in the US banking system. If SVB's assets can only be sold for, say, 90 cents on the dollar, it could encourage banks to run elsewhere. It could encourage bank runs elsewhere. Okay, but let's say that acquisition doesn't happen. Then what? Well, the FDIC evaluates, then sells the assets associated with Silicon Valley Bank over a period of weeks or months, with the proceeds going to depositors. Uninsured deposits rank high on the payback scale, behind only administrative expenses and insured deposits. So, if a sale doesn't happen soon, the odds are high that customers will get their money back, assuming they can stay afloat waiting for it. How did we get here? So this is actually bigger than startups and Silicon Valley VCs. To understand how this happened, we've got to talk about interest rates. Since 2008, they've been pretty low. Since 2008, they've been pretty low, sparking a venture capital boom and some real silliness. See, WeWork, Theranos to zero. There's been a lot of fraud for a long time, and it got worse during the pandemic. When the money printer went burr, meme stocks, crypto boom, SPACs, thank Federal Reserve Chair Jerome Powell, who settled on 0% interest rate policy. Jerome Powell, who settled on 0% interest rate policy or ZIRP. So if you are, let's say, a bank specializing in startups, do you know what ZIRP does to you? Well, my children, according to the most recent annual filing from SVB, bank deposits grew as IPOs, SPACs, VC investment, and so on went on a frenetic pace. And because all of these liquidity events, congrats by the way, no one needed a loan because they had all this cash. This is sort of a problem for a bank. Loans are an important way to make money. So, as explained in more detail by Bloomberg's Matt Levine, Silicon Valley Bank bought government securities. This was a fine and steady way for SVB to make money, but it also meant it was vulnerable if interest rates rose, which they did. Powell started cranking up rates to slow inflation and told Congress this week that he expects to let them get as high as 5.75%, which is a lot higher than zero. Here's the problem for Silicon Valley Bank. It's got a bunch of assets that are worth less money if interest rates go up. It's got a bunch of assets that are worth less money if interest rates go up. And it also banks startups. Which are more plentiful when interest rates are low. Essentially, these bankers managed to put themselves in double trouble, something a few short sellers noticed. Pity the shorts, despite being right, they also fuck because it will be hard to collect their winnings. Pity the shorts. Despite being right, they also fuck because it will be hard to collect their winnings. Right? So, did Silicon Valley just flung the prisoner's dilemma? Dilemma? How to pronounce that? Dilemma. I always read it as dilemma. Dilemma. That's how you pronounce it. Dilemma. So, did Silicon Valley just flung the prisoner's dilemma? Okay, this mismatch in risks in and of itself won't tip a bank over. A good old-fashioned bank run did that, and at Silicon Valley Bank, there was no George Bailey to stop it. Here's how it happened. When interest rates rose, VCs stopped flinging money around. Startups started drawing down, more of their money to pay for their expenses. And SVB had to come up with cash to make that happen. That meant the bank needed to get liquidity. So it sold 21 billion US dollar of securities, resulting in an after-tax loss of 1.8 billion. It also came up with a plan to sell 2.2 billion in shares to help shore itself up. Moody's downgraded the bank's credit rating. In its slide deck explaining all this, Silicon Valley Bank talks about, "I am not making this up. Ample liquidity and its strong capital position." Now, recall another bank called Silvergate had just collapsed for crypto reasons. Investors, like horses, are easily spooked. So when Silicon Valley Bank made this announcement on March 8, people bolted. Peter Thiel's Founders Fund advised its portfolio companies to pull out, ultimately yanking millions. And you know how VCs love to follow trends? Union Square Ventures and Coty Management, among others, decided to tell companies to pull their money too. This bank run happened fast. In less than 2 days. Tech nerds can take credit for that one. It used to be that you had to physically go to a bank to withdraw your money, or at least take the psychic damage of picking up a telephone. That's a slower process. Give banks time to maneuver. In this case, digitalization meant that the money went out so fast that Silicon Valley Bank was essentially helpless, points out Samir Kaji, CEO of investing platform Allocate. Customers tried to withdraw 42 billion in deposits on March 9 alone, a quarter of the bank's total deposits on a single day. It was over the next day. The share sale was cancelled. Silicon Valley Bank tried to sell itself. Then the regulators stepped in. Who was in charge here? Until the failure of Silicon Valley Bank, its now former CEO Greg Becker was a director of the Federal Reserve Bank of San Francisco. That's one of the 12 banks overseen by the Washington Fed. While the bank run was ongoing, Becker told VCs, "I would ask everyone to stay calm and to support us just like we supported you during the challenging times." As anyone who has ever been in a long-term relationship knows, telling someone else to calm down is a way to ensure they lose their entire goddamn mind. I think it might have been possible to staunch the bleeding if Becker had been even halfway good at PR. Obviously, he's not. But separately from Becker's ill communication, he was the leader behind the spooky asset sale or share offering combo punch. In fact, Silicon Valley Bank had other options. It could have borrowed funds or tried to offer sweet deals to depositors who stay. That's not all. It turns out Baker also sold 3.6 million of shares in Silicon Valley Bank's parent company. On February 27th, this was a pre-arranged sale. He filed the paperwork on January 26th. But it does seem like curious timing. Baker was presumably aware of his own balance sheet. And a director of a regional Fed bank. He had to know the Fed was going to keep raising interest rates. I mean, if I knew it, he'd better have known it. And he had to know that would be bad news for Silicon Valley Bank. What does this mean for startup land? The venture capital ecosystems exist because once upon a time, banks wouldn't loan startups money. Think about it. A 23-year-old nerd slapping together a startup in someone's garage or whatever usually doesn't own anything they can put up as collateral against a loan. One way that Silicon Valley Bank bolstered startups was by offering risky forms of financing. For instance, the bank lent against money owed. For instance, the bank lent against money owed to a business account receivables. Whatever the hell is that mean? Even riskier, lend against money owed to a business account receivables. Even riskier, the company lend against expected revenue for future services. Expected revenue for future services. Silicon Valley Bank also offered venture debt, which uses a VC investment as a way of underwriting a loan. And it worked. These kinds of products help build Silicon Valley into the powerhouse it is now, says Jonathan Hirschman, who's done high-tech PR for the last 30 years. The bank also would get slices of companies as part of its credit terms. That meant it made $13.9 million on Fitbit's IPO, for instance. More recently, Coinbase IPO paperwork revealed that Silicon Valley Bank had the right to buy more than 400,000 shares for about $1 a share. Coinbase shares closed at a price of $328.28 the first day it was listed. Wow. Startups aren't the only ones who need to raise money. Venture capitalists do too. Often from family offices or governments. Silicon Valley Bank invested in a number of VCs over the years, including Excel Partners, Kleiner Perkins, Sequoia Capital, and Greylock. This kind of gets us to one of SVB's key problems. Silicon Valley is actually a small town. And while that meant SVB was the cool banker for the tech and life sciences startups here, that also meant its portfolio wasn't very diverse. The incestuous nature of Silicon Valley startups means gossip is a contact sport. Because everyone here is hopelessly entwined with everyone else. I don't know if this is going to lead to bigger problems. It could. a lot of other banks are also losing money on their securities. But the gossipy nature of Silicon Valley and the fact that so many of these firms are entwined made the possibility of a bank run higher for SVB than it was for other places. Right now, rumors are flying in WhatsApp group chats, full of founders scrambling for cash. I suspect, too, that we will start seeing scammers attempting to target panicky technology brothers to extract even more cash from them. I don't know what's going to happen now, and I don't think anyone else does either. I do know, though, that SVB's leaderships weren't the only ones who fucked up. This was the second big bang failure in a single week, suggesting our regulators were asleep at the wheel. And who was the primary regulator for both banks? Why? Our friends at the Fed. That's it.